Hello and welcome back to Global Value. In today's video, we'll be performing a fundamental stock analysis of Safe Bulkers Inc., ticker symbol SB. At the time of recording this video, Safe Bulkers is trading for just under $5 a share. Year to date, their stock price has done quite well. They're up 30.5%. Over the past year, they're up about 27%. Going back 5 years, they're up 21.5% compounded annually. However, going back 10 years, they're down 20%, which is about down 2% annually. And going back 14 years from their IPO at a pretty rough time in 2018, they're down about 10% annually, down 74% overall. So Safe Bulkers is trading toward the higher end of its 52-week price range. Its 52-week low was at $3, and its 52-week high was at $5.44. At the time of recording this video, Safe Bulkers has nearly a $600 million market cap. Safe Bulkers operates as a holding company. The company, through its subsidiary, provides maritime dry bulking transport services. Its other business activities include transporting bulk cargoes, particularly coal, grain, and iron ore. As of March 18th, 2022, the company had a fleet of 40 dry bulk vessels, having an average age of 10.4 years and an aggregate carrying capacity of nearly 4 billion deadweight tons. Its fleet consists of 12 Panamax vessels, 7 Kamsarmax class vessels, 15 Post-Panamax vessels, and 6 Cape-size vessels. Recently, they've been buying up new Cape-size vessels as well. Safe Bulk Inc. was incorporated in 2007 and is based in Monaco. We'll be performing a modified 8-pillar analysis as popularized by Everything Money, taking a look at 8 different financial metrics to come to a holistic beginning understanding of Safe Bulkers based on their financials. So let's get right into the analysis. Starting off with pillar number 1, we want their average 5-year PE to be below 22.5. So currently they're trading for just over 3 times earnings. Over the past 5 years, they've been trading for about 4 times earnings. So pillar number 1 is a check to start. Pillar number 2, we want their average 5-year return on capital to be above 9%. So they've done quite well, especially in the past year. Compared to their peers, most of their peers have had negative returns on capital in at least one of these 5 years. They've had positive returns on capital in all 5 years, so that's a good sign. Averaged out, they produce about a 6% return on capital, which is below that 9% mark we were looking for. So pillar number 2 is going to be our first X. Pillar number 3, we're looking for 5-year revenue growth. They've doubled revenues over the last 5 years, so this is a check here. Next up, pillar number 4, we're looking for 5-year net income growth. They had negative net income in 2017, and they had $174 million of earnings in 2021. So that's going to be a check on pillar number 4. So far, we're 3 for 4. Next up, pillar number 5, we're looking at shares outstanding. We don't want a business to be issuing new shares and diluting existing shareholders. When you purchase a stock, what you're really buying is an underlying ownership percentage of a business. When a business issues new shares, they're decreasing their existing shareholders' ownership percentage of the business. As investors, what this means is that if a business dilutes you, you're entitled to a smaller percentage of their overall profits going forward. So here, it's not the worst dilution we've ever seen, but they have diluted shareholders. They had 101 million shares outstanding in 2017, and that's increased to nearly 114 million as of the end of 2021. So this is another X on pillar number 5. We're 3 for 5 so far. Next up, pillar number 6, we're looking for 5-year free cash flow growth. Free cash flow is this column here in green. It's the lifeblood of any business and can be used to pay dividends, buy back shares, pay down debt, make acquisitions, or reinvest back into the company. This one's going to be a check. They had negative free cash flows in 2017, but each of the next 4 years they've had positive free cash flow. Last year, they did about $108 million of free cash flow, which is a huge jump over their previous years, in line with the rest of the shipping industry more generally. Over the last 12 months, they've actually done $130 million of free cash flow. So that's a large amount relative to their past history. Averaged out over these 5 years, the business produces about $34 million of free cash flow a year. So we'll use that when we're evaluating how the business utilizes leverage and then how the business's current market cap compares to this free cash flow profile. Next up, for pillar number 7, we want the business's net debt, which is long and short-term liabilities minus cash and short-term equivalents, to be below their average 5-year free cash flow multiplied by 5. So as of the end of last year, they had $275 million of net debt. If we multiply their average 5-year free cash flow of $34 million times 5, that comes out to $170 million. So that's off by about $105 million. So this business, although they are growing cash flows more recently, they're employing more debt in their business than we're necessarily comfortable with. So pillar number 7 is going to be an X. Lastly, the big pillar of them all, pillar number 8, we want their market cap to be below their average 5-year free cash flow multiplied by 20. So currently they have a market cap of about $600 million. When we multiply their average 5-year free cash flow of $34 million times 20, that comes out to $680 million. So that gives us about an $80 million margin of safety based on their current market cap. So that's a check on pillar number 8. Just because the business looks good from their free cash flow profile doesn't necessarily mean that we should be jumping in and investing in this business blindly. We want to consider the business and its financials holistically. And while this type of analysis does give us a good idea of the business, it's just a starting point. To learn more about the business, I highly recommend reading through the company's filings and understanding the industry that it operates in. The shipping industry is extremely cyclical, and so we have to understand how these boom and bust cycles progress while having a general inclination of where this company stands within that cycle. This isn't something that's necessarily knowable, but it is very important for the future of the business. So lastly, I just want to point out that Safe Bulkers, very different from its peers, does not pay out any sort of dividends. So last year they had 85 cents of free cash flow, and over the last trailing 12 months, they've had $1 of free cash flow. That's a very high free cash flow yield compared to their current stock price. But one of the big things we need to consider is that this industry is highly cyclical, and a lot of their peers are taking this extra free cash flow that they're bringing in over the course of last year and into this year and returning it directly to shareholders, either through buybacks or through dividend distributions. So in order to be comfortable investing into Safe Bulkers, it's absolutely critical that we do more research, do our homework here, and understand exactly how management is allocating capital and why they're making those decisions to understand if those are in shareholders' best interest moving forward. So in summary, Safe Bulkers checks the box on 5 out of 8 pillars. Similar to a lot of its peers in the shipping industry, it's seen huge spikes in free cash flow this past year. Although different from its peers, it's not paying out dividends. So we really want to understand how management is allocating capital. Well, guys, that's it for today's fundamental stock analysis of Safe Bulkers Inc., ticker symbol SB. If you enjoyed the video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next. Thanks for learning about Safe Bulkers with me, and have a great day.